Good morning, Southern California. I'm John Baldwin with John Hart Real Estate, and today is March 14th, 2022. I love March 14th because for math nerds like me, it's Pi Day, 3.14. So happy Pi Day to everybody. What I want to talk to you about today is something I've actually been harping on for a little while. It's the expected rate hike. The Fed's meeting this week. We should know more about the rate hike that everybody has been talking about for the last several months. When rates go up, do not be surprised. We've all known that this is what they've been telegraphing for a while. But what are the impacts on you? What is the impact on you, the consumer? So let's jump into a CNBC article. It's titled, "Here's a breakdown of how the Fed's expected rate hike will impact your wallet." It's on CNBC.com. So the Federal Reserve is widely expected to start raising interest rates this week to help tame inflation. Well, we've been harping on the inflation, issue for a while now because, hey, when you print money like it's your freaking job, what else is going to happen? I think the easiest explanation of what inflation is just when you look at fractions. If you got, 1 out of 10, that one is worth 10%. But if you're at 1 out of 100, 1 out of a million, you see what I'm saying? When they print money, they are expanding the denominator, the bottom of the fraction, while the top of the fraction, that one, stays exactly where it was. So you're going 1 out of a million, 1 out of a billion, 1 out of 30 trillion. So I think that's the easiest explanation, is that you're basically expanding the denominator of a fraction while, the top is at 1. All right, that's you're explain it to me like I'm 5, but whatever. I think that's a very good way to look at it. But then here we are with some Federal Reserve points from an economist at bankrate.com. And they're talking about credit card debt, auto loans, mortgage rates, student loans, things like that. So for credit cards, there's going to be an immediate impact. So if you haven't refinanced and paid off your credit card so that you can get the low mortgage rate and not the higher credit card rate, when the Fed raises interest rates, your credit card rates are going to go up because they are adjustable rates tied more directly to that Fed funds rate. So that's definitely something to be concerned about, because that's going to affect your debt to income ratio if you're shopping for a house. So if all of a sudden your monthly expenses go up because interest rates go up, your debt to income ratio will be affected. So definitely something to look at. And that data points from Matt Schultz, chief credit analyst for LendingTree. So what else? All right, auto loans. Can definitely, let's see, will not have a material effect on auto loans. So yeah, because banks are a lot slower. They build into their existing rate kind of things that they're anticipating, so they're not left out on a limb. But yeah, so, auto loans are not super directly tied to the Fed funds rate. So, and then mortgages, 30-year fixed rate mortgage has already risen to an average of 4.14. That's up a full percentage point since November. If you've got an adjustable or a HELOC, a home equity line of credit, those, because they're adjustable, are more directly tied to the Fed funds rate than a fixed mortgage, because you've got a fixed mortgage. But anybody shopping for new mortgages, they're going to be factoring in higher rates to their price structure, their fee structure. That's something to consider. And then student loans are fixed, so they aren't really impacted. But if it's not a government-backed loan, then there might be an issue there. Savings, this could be interesting. Yeah, deposit rates will be much slower to respond to the Fed's rate increase, even though only modestly. While the Fed has no direct influence on deposit rates, they tend to be correlated to changes in the target Fed funds rate. So yeah, you might get a little bit of a bump, but it's going to be a very slow bump, a very small one. So I don't think that there's going to be a big big move by banks moving auto loans or personal loans or deposit rates or anything like that. So nothing super concerning here. But yeah, it's just definitely something to, if you haven't refinanced and you're in a position that you can actually still drop down a good chunk. Like if you're still in the 5% range on your mortgage and you can get down to that like 4% range, 4.14 area, then that's going to save you a lot of money, and you're going to be able to get out from under your credit card debt and improve your debt to income ratio because you rolled all that into your mortgage. So definitely something. If you need a lender, give me a call, 213-973-3777, and let's get your house sold.